With soaring inflation and the shadow of recession hanging over the United States, the Federal Reserve announced a 0.75 percentage point increase in interest rates on Wednesday, the largest hike since 1994. Until this week the Fed had been expected to announce a smaller increase. At a press conference, the Fed chair, Jerome Powell, said the central bank decided that a larger hike was needed after recent economic news, including last week's announcement that inflation had risen to a 40-year high. He made clear that a similarly outsized rate rise should be expected at its next meeting in July unless price rises softened. "We at the Fed understand the hardship inflation is causing," he said. "Inflation can't go down until it flattens out. That's what we're looking to see." The hike will increase the Fed's benchmark federal funds rate to a range between 1% and 1.75%, and officials said they expected rates to rise to at least 3% this year. Powell acknowledged that the Fed's attempt to cool spending is likely to lead to job losses. The Fed expects unemployment to rise to 4.1% from the current rate of 3.6% as it attempts to bring inflation back down to its target rate of 2%. "We never seek to put people out of work," Powell said. "But," he added, "you really cannot have the kind of labor market we want without price stability." The rate rise came after more bad news on inflation late last week sent U.S. stock markets into a tailspin, presenting the Fed and the Biden administration with an escalating crisis amid fears that runaway inflation has now spread through the economy. The Fed cut rates to near zero at the start of the coronavirus pandemic, as the U.S. and global economies effectively shut down. It increased rates for the first time since 2018 in March this year, but the increase did nothing to tamp down rising prices.